So I'm very curious to get your take on what a market sell-off, like the kind we've seen over the past 3 days, not today, how does that put pressure on private market investors? Because certainly the pensions and the endowments that are invested in PE are feeling nervous.
Well, I would say the first great thing is that all of us who are in private equity are happy to be in private equity when we see this kind of volatility, right? So private equity is about long-term decisions. It's about very patient capital. And it's really, not about the day-to-day. It's not the next 10 days. It's really about the next 10 years. And so therefore, because of the way we're thinking about adding value in companies over the long term, we actually don't have to be worried about the day-to-day volatility.
But here, what is going on with what people are calling here the denominator effect? Because what's happening now when you see these sell-offs is you all of a sudden have these private asset portfolios balloon to be a bigger part of those larger LP portfolios. What is exactly happening there?
No, that's a real issue, especially if it happens over an extended period of time. So if you start to look at quarter ends and you still see this big backdrop and downdrop in the public markets, it certainly will have an impact on the value of those private equity portfolios as a percentage of the total. And if that percentage becomes higher than what the allocation is intended to be, then many institutional investors will need to cut back. The hope is that, this is hopefully, minor and short-term volatility. And by the time we get to the end of the quarters, which is generally when these decisions are being made, that you will actually see the markets coming back. But the denominator effect can be very real, That being said, at the same time that you have folks that might have to cut back, I was actually just with one of the largest institutional investors last week, and they're actually putting more into the market. They've been underallocated to private equity, and so they've actually already put more than $4 billion in private equity investments already this year. And so, as you can see, at a time like this, it could precisely be a great opportunity to be adding more to private equity.
So there's a lot of shuffling, and it's just a matter of who is in what kind of position. But that idea that they'll need to cut back at quarter end, how does a private equity firm comply with that? How do you prepare for a moment like that at the end of the quarter?
So the good news again around the private equity, so the monies that you've already invested is locked up, right? And so what you want to do is certainly with your larger institutional investors is figure out if there's a need for more liquidity. And then there are lots of things you can do. Like our business, we're committing about $18 billion last year across the private markets assets. And so many of the areas in which we were investing in were to actually provide liquidity to some of the underlying companies so that private equity firms could return liquidity to their LPs, thereby helping them to erase some of the concerns around the denominator effect.
How do you feel about that dynamic? Because ultimately this has impacted fundraising. Even the biggest firms in the world with very profitable funds have not been able to raise new money because these large LPs just have too much money in private equity already. Some of that money is being returned through those strategies. But if you see the market sell off like it has been, does it kind of prolong the ability for new funds to raise more money?
It could. I mean, one of the things you've seen here over the last couple of years is that on average, it's been kind of 18 months to raise a fund. That's a much bigger timeline than what we've traditionally seen here over the last decade. And even some of the largest names have not been immune from this, right? Some of the brand names have actually started to occur. But that being the case, I do think that there are lots of things that private equity firms can do to make sure that they continue to show their value. I mean, really having this value creation playbook wherein they're going to go in and buy these companies and make them better, increase their earnings, really be able to beef up management, really those things, and really looking at those companies that have the resilient business models and being able to do that day in and day out, I think then proves themselves, it will prove themselves to many of the limited partners in which they're trying to attract.
There's private equity, there's also private credit in the private markets, and there's still areas where record funds are being raised, private credit being one of them. Do you worry that we're in bubble territory there?
No, I think that when you think about the percentage that private credit still, still is in terms of the total debt markets, there's still so much room to grow. And in fact, it's been great when you think about the fact that banks, many of the largest institutional banks, needed to cut back over the last few years in terms of their lending. I think one of the reasons why you've seen the private equity market stay as robust as it has, and broadly, it's because private capital lenders stepped in when many of the large institutional banks had to step out.